All right, welcome everyone. Let's just dive right into this explainer. Today, we're looking at something pretty incredible. We're taking the foundational investment strategies of the legendary Warren Buffett, but we're doing something specific with them. We're tailoring them directly to how you can use these exact principles to grow your everyday savings. We're not talking high-level pie-in-the-sky theory here, right? We're unpacking the actual mechanics. We'll look at how time, relentless discipline, and just understanding intrinsic value can literally turn a totally modest savings account into an unstoppable compounding machine. You know, it's actually fascinating to look back at Buffett's own early days. He famously bought his very first stock at age 11, 3 shares of City Service Preferred, and he often jokes that he was just wasting his life up until that point. But the real takeaway from the source material is simply this. He started small. He applied a rigorous framework to very limited capital, and that's exactly what we're going to explore today. How you can take that exact same structured approach, bypass all the noise of the modern market, and build your own financial foundation using the exact same mechanics that created literally one of the greatest track records in investing history.
So think you need millions to invest? Honestly, it's a question that stops so many people dead in their tracks before they even begin. And look, the financial industry often profits from making investing seem like this impossible, complex, walled garden. Like you need a hedge fund manager's salary just to even participate. Wall Street absolutely thrives on high-frequency trading, complex derivatives, and honestly, constant anxiety just to generate fees. But the Buffett approach, it completely bypasses all that noise. The source material highlights that the single greatest illusion in personal finance is this idea that there's some massive capital barrier to entry. There isn't. Buffett's framework doesn't rely on upfront wealth. It relies on fundamentally sound mechanics. It's really about finding businesses with durable competitive advantages, what he famously calls economic moats, and then just letting the broader market do the heavy lifting over time. This strategy totally dismantles the idea that you have to be ultra-wealthy to generate serious wealth. You really just need to ignore the Wall Street circus and stick to a proven, rational framework.
$500. That's it. That is where the true starting point lies. And I find it incredibly empowering to see this specific figure anchored in our source material because it validates a profound truth. You absolutely do not need a massive windfall to start generating real momentum. This isn't just about, parking cash in an account somewhere. It's about the snowball effect, which is a concept absolutely central to Buffett's whole philosophy. He views every single dollar not just as a piece of paper to be spent today, but literally as a seed capable of immense future compounding. So when you start with just $500, you aren't just making a deposit. You are planting the first seed of a portfolio that is designed to grow exponentially. The real trick here is a fundamental shift in mindset. Instead of looking at $500 and thinking, well, that's way too small to really matter, Buffett's framework demands that you see its future value. What is that going to be 10, 20, or 30 years down the line? That initial sum, however modest it might seem, is the critical catalyst that sets your entire wealth accumulation engine into motion.
Now, moving up to the $5,000 mark, we start to see how this modest capital actually gets deployed out there in the real world. If you are sitting anywhere within this $500 to $5,000 range, guess what? You are in the absolute perfect position to execute Buffett's core advice for the everyday investor. The source material makes it crystal clear. You are not supposed to be out there picking obscure, highly risky penny stocks. Please don't do that. Instead, this starting capital is perfectly suited for low-cost S&P 500 index funds. And the best part? By utilizing modern brokerages that offer fractional shares, literally every single cent of that initial money can be put to work right away. You can implement something called dollar cost averaging. That's just continuously funneling portions of your savings into a broad market index, no matter if the market is having a good day or a bad day. It completely eliminates that totally futile exercise of trying to time the market. Instead, it guarantees that you're consistently acquiring little pieces of ownership in the most profitable companies in the world, and that allows broader economic growth to naturally expand your savings over time.
So the Buffett formula, especially in this context, is entirely about applying those time-tested principles to that modest capital. But what actually are these mechanics? Well, first and foremost, as Buffett famously likes to say, rule number 1 is never lose money, and rule number 2 is never forget rule number 1. In practical terms, this just means avoiding highly speculative, super risky bets and instead focusing on preserving your capital while seeking out steady growth. Secondly, it's about investing in what you actually understand. You want to seek out those economic moats we talked about, companies with unassailable competitive advantages, really strong brand loyalty, and just consistent earning power. And honestly, perhaps the most important thing for growing everyday savings is the principle of holding assets over the long term. You are not day trading your $500, okay? You are acquiring small pieces of exceptional or even just fundamentally really solid businesses and letting the natural upward trajectory of the market multiply your initial stake. The mechanics of growing savings absolutely rely on these rigorous principles, ensuring your foundation is built on solid rock rather than speculative sand.
Apply his principles today. Look, the absolute crucial point here is that final word, because the entire success of this formula is mathematically dependent on immediate application. Growing your savings through this framework requires the unmatched engine of time. Buffett often echoes this famous sentiment that compound interest is the eighth wonder of the world. But here's the catch. Compounding only works if it has years and ideally decades to actually run. If you take $500 today and let it compound at a historical average market return, that growth curve eventually starts to become exponential. But if you wait 10 years to invest that exact same $500, you've fundamentally crippled the math. The opportunity cost of waiting is just staggering, and the source material makes such a vital point here. You do not wait to invest until you are rich. You invest today precisely so that the mathematical force of compounding can begin doing the heavy lifting for your savings right now. Time is literally the absolute most valuable asset in the Buffett playbook. And the best part? It's the one asset that is freely available to every single one of us today.
Okay, so to practically put this compounding engine to work, we have to look at the standard 401k versus a personal brokerage account. And this isn't just about picking a random finance app on your phone. It's about selecting the optimal environment for Buffett's buy and hold forever mentality. Now, the 401k is an absolute powerhouse for this strategy. It offers massive tax advantages that immediately boost your effective capital. But honestly, more importantly, it provides a psychological barrier. Because you can't easily withdraw those funds without taking a penalty, it practically forces the exact kind of long-term discipline that Buffett always champions. It stops you from panic selling during those inevitable market dips. Now, on the flip side, a standard brokerage account offers you the ultimate flexibility to invest in those low-cost S&P 500 ETFs totally on your own terms. But both of these everyday vehicles are perfectly suited for acquiring those broad market index funds that Buffett heavily recommends for everyday investors like us. They are the tangible vessels where your modest capital securely anchors into the market, keeping fees low and maximizing your exposure to long-term economic growth.
And this brings us to a clear, structured roadmap for building what is essentially an automated wealth machine. Acknowledging your starting point, selecting your financial vehicle, and immediately putting the principles to work. I mean, it sounds incredibly straightforward, right? Yet psychologically, most people completely fail to execute this. And why is that? Well, human nature makes us want to overcomplicate things. We try to time the market. We hoard our cash because we're terrified of a market correction. Or we swing the other way. We get overly greedy and start chasing the latest speculative bubble. Buffett's genius is in engineering a system that removes emotion from the equation entirely. By just committing to start with whatever modest capital you have, funneling it systematically into an optimized account, and doing it today, you completely bypass the psychological traps that destroy wealth. You aren't gambling here. You're systematically deploying capital based on intrinsic value and the undeniable math of compound interest. This process just strips away all the fear and the noise of the 24/7 financial news cycle, giving you an automated, highly disciplined framework to consistently turn your ordinary savings into real long-term wealth.
So, as we've seen, this legendary framework for growing your savings isn't locked away behind some massive Wall Street paywall. It simply relies on the fundamental mechanics of utilizing low-cost index funds, leveraging the massive tax and psychological advantages of standard investment accounts, and just unleashing that mathematical snowball of compound interest. When you do this, you're not just opening a bank account. You're setting up a compounding engine built on the strict, time-tested discipline of one of the greatest investors in history. The tools are literally right in front of you. The principles of value, time, and consistency are fully accessible right now. Which brings us to the single most important question you can walk away with from this explainer. What will you do with your first $500 today? Because the time to plant that seed and let the market start working for you is right now. So how will you take that critical first step?